Do you want to be the next fastest self-made billionaire? Warren Edward Buffett, a famous investor and CEO of Berkshire Hathaway, took about 55 years to become a billionaire. On the other hand, Jay Walker snapped his fingers and did it in less than a year. When he launched Priceline.com, his net worth immediately jumped from zero to billions. But its sustainability wasn't firm because when the bubble burst, his net worth came crashing with it. While Buffett is on top of the billionaire list, he doesn't seem to go anywhere anytime soon. That's the kind of wealth you would like to establish. Cultivating money is not a walk in the park. It is competitive, tough, and cruel. Without any prior knowledge of its rules, you are simply doomed. One common mistake people make is that they work hard for the rest of their lives, but at the end of the road, they still end up poor. This is because they don't know how to make their money grow. Simply put, they don't know how to invest. Let's assume that you've regularly been saving money and have an extra $1,000 in your bank account. This is already a great accomplishment, for nearly 70% of Americans don't even have an extra $1,000 in their bank account. Instead of buying clothes and other materials that you will only use at least twice, or maybe something that you just store in your closet before you discard it, let's assume that all that money will go into an investment. Bottom line, how do you invest your first $1,000? Should it be invested in real estate or the stock market? What kind of stocks would be ideal to buy? Is $1,000 even enough to start investing? All your questions will be answered if you stick with us until the end of this video. Let's get right into it. To grasp the main concept of what investing is and how it works, consider this example. Let's say you had a whopping $300,000. You can head straight into getting yourself a shiny new Ferrari and shoving your success into people's faces, or you can opt to buy a real estate and rent it out. The latter option will continuously give you $2,000 every month. If you decide not to keep on receiving that $2,000, you can sell it and get your initial investment back. If truth be told, the value of your investment might even double or triple if you sell it for a higher price. That, ladies and gentlemen, is how you make money. Make more money. However, you can't buy real estate for only $1,000. It's not even enough to cover the expenses for its down payment. Even so, it does not mean investing that $1,000 elsewhere is impossible. The simplest way would be to deposit it into a savings account and generate interest, but take this chance to channel your inner critical thinker. Why would the bank pay you for keeping your money there? Shouldn't they be charging you instead? The answer is no. The bank is taking your money and using it to loan that amount to someone else at a higher rate. A portion of that profit would then be shared to you. Congratulations! You just finished your crash course on how banks work 101. We would suggest that knowing this would be ideal than robbing one. All jokes aside, the only drawback would be that the interest on the deposit account is so low that it's not even worth it. The biggest rate that you can acquire is 0.8%. This means that if $1,000 gets put into a savings account, 12 months from now you will only receive an extra $8. That is extremely low, for the FED targets an inflation rate of 2 to 3%. This means that you are not getting at least 2 or 3%. Over time, the real value of your $1,000 will cheapen, which means every year you get to buy lesser goods with it. With this in mind, why are interest rates low on deposit accounts? This is because interest rates in general are growing sluggish this year, since the pandemic caused the Fed to lower them to encourage people to spend and borrow money. A year or two from now, when the pandemic is nothing but a distant memory, the Fed will increase interest rates to 1, 2, or even 3%. This means that the interest rates on the savings account will increase as well. Another ideal option would be to buy government bonds. Government bonds are issued by the government to raise money to support the spending of the government. Let's say the government wants to build a school, but there is a lack of funds to execute that. They then issue an IOU. This is a piece of paper that states that whoever owns this security is owed this amount of money plus interest by the US government. Obviously, this is a simplified example, but you get the point. Government bonds are heavily influenced with interest rates. Since interest rates are low this year, government bonds are less than 1%. However, 2 years ago, when the interest rates were high, the rates went over 3%, which seems like a pretty good deal since government bonds are one of the safest investments you can ever make. All investments have their own risks. If you're loaning money to the US government, what are the chances of them defaulting on its loan? For the whole government to go bankrupt, the entire economy needs to crumble down. This explains why US bonds are considered the safest investments ever. However, if you want to make a higher return, let's say 10, 20, or 30%, then investing in the stock market might just be the thing for you. Amazon's stock price increased by over 80% this year. Google's stock price rose by almost 30%. Tesla's went over by a staggering 721%. Indeed, you heard it correctly. 721%. The question at hand is, why would you invest elsewhere when you can double or even triple your money in the stock market? The answer would be risk. In government funds, for example, risk is not that much of an issue. It can even be called risk-free in a way. However, when it comes to individual companies, risks of the company failing are possible. It might even gain negative earnings. Any negative news can cause the stock market to decrease or price down. One company might present a new product, and if it doesn't please its consumers, that can create negative headlines that will drive the price down. It is safe to assume that with higher returns come greater risks. Apple is a renowned company, but its chances to fail are lower than Tesla. However, it also has less room for growth than Tesla. This explains Tesla's growth by 721% this year and Apple with just 70%. Now you just have to assess yourself on how much risk you can take without running around like a headless chicken. If that $1,000 is all that you have, maybe risking all of it is not the best decision, because when things turn south, you can end up losing more money than gaining some. This is why investors minimize their risk by investing in an index. The most famous one is the S&P 500 that tracks the top 500 US companies. An index fund would simply invest in these top 500 companies. Taken, not all of these companies are destined to succeed. Some will definitely fail, but think of the ones that would grow. Speculating historical data, the average return rate of the S&P 500 since the 1920s was about 10%, which means when one buys a share of these index funds, you are basically buying a small portion in the top 500 US companies. One of the best index funds are VOO or Vanguard 500 Index Funds, QQQ, and index funds by Invesco, and Fidelity Zero Total Market Index Fund. All of them are equally good and they invest in the exact same companies. Now, how do you buy shares in these index funds? Where do you even start? First, find yourself a broker, someone that is qualified to sell you stocks. Remember Leonardo DiCaprio from The Wolf of Wall Street? He would spend his entire day calling people and convincing them to buy stocks. But then again, this is the age of technology and things are much easier for everyone. Brokerage firms designed apps so that you can buy shares from the comfort of your own home and on a click of a finger. Robinhood and Webull are examples of the said apps. You just simply have to download the apps, sign up, and investing can be started right away. Well, that's about it. We tried our best to simplify this video to encourage you to start your investments. What usually happens is that when you start investing, a million questions run through your head and you start researching. After that, you get exhausted and soon enough you just give up and put the investment dreams on hold. We hope this wouldn't be the case after watching this video. If you found today's video helpful, please leave a like and comment. It helps us grow our channel and deliver these types of videos to a wider audience. If you want to be kept posted on wealth building tips and strategies, feel free to subscribe and click on the notification bell. Have a great week!